Hello and welcome to this month's Financial Markets Update. Well, August proved to be another volatile month for financial markets. Domestically, the corporate reporting season was in full swing, while global equities continue to be buffeted by the direction of US cash rates, as well as a range of ongoing global economic challenges, led by the energy disruption that continues to face Europe. In China, another major city lockdown in Chengdu, populace of 21 million people, combined with the ongoing economic weakness against a backdrop of a property market that's showing few, if any, signs of revival, along with the weakening trade flows, is putting further strain on both Asian as well as global equity markets. All the while, inflationary expectations continue to rise, which is forcing central banks, led by the US Federal Reserve, to maintain tighter monetary policy. While the US is using higher rates to quell robust domestic demand, in the UK and Europe it clearly is a different story, with the elevated energy prices really requiring the Bank of England and the ECB to raise cash rates as they seek to dampen those inflationary expectations. What is clear from our perspective, and certainly from the policies of central banks, is that fighting inflation remains a key priority, irrespective of the negative impact on economic growth. We now see a recession, a high probability, global recession, a high probability over the next 12 to 18 month period, as the impact of higher cash rates filters through the global economy. While the PMI surveys in the US continue to reflect an economy that continues to be in expansionary mode, domestically, in our view, it remains a somewhat contradictory story. While the Australian labour market remains sound, with the unemployment rate roughly around about 3.5%, and the second quarter GDP figures also pointing to a robust consumer, building approvals, for example, in August were down over 17%. This is well above consensus, which was roughly around about -3% for the month. And while the ISM surveys for both the manufacturing and service sectors of the economy remain positive, they are effectively flat month to month and are just in the expansionary side of things. So nevertheless, from our point of view, when we think about a recessionary environment here, the key indicator will be reflected in the strength of the labour market. And while the lack of labour supply remains a real issue for the domestic economy, low unemployment does provide some insulation for the economy from the negative impact of both slower growth and higher cash rates that are going to continue to come through the system. Therefore, given this conflicting outlook for growth, it was really a little surprise when we saw quite a significant market sell-off in both bond and equity markets throughout August. The S&P ASX 200 bucked a trend off the back of a solid reporting season led by the resources sector. The broader index was up just a tick over 1% for the month. However, global equity markets were weaker, down anywhere between 2 to 3% over the month. And despite the positive backdrop from a recent reporting season in the US, we believe this is generally as good as it gets for equity markets in the terms of earnings growth in the next little while, certainly through to the back end of the year. With official cash rates set to rise further and a clear policy goal of bringing inflation lower via slowing growth, we envisage the earnings outlook will continue to moderate through to the back end of 2022 into 2023. While equity markets were generally weaker over the month, the big negative for investors was in bond markets, where the capitulation of performance of growth across both global and bond markets continued. Our local bond market index was down 2.5%, while global bond markets were also lower, down roughly around about 2.5 to 3%. Domestic and global composite bond indices are now down 11.5% and 10.5% respectively over the last 12-month period. And we need to go back to the 1970s to see a period as weak as this for global bonds. For investors in longer duration strategies, this has been an incredibly difficult investment period, and in our view, with central banks still in the early to mid phase of their tightening cycles, we expect that bond yields will continue to move higher, putting further pressure on the performance returns of fixed income markets. Given that the domestic inflation rate remains above 6% and is likely to move higher over the next quarter, we do envisage the RBA will increase official cash rates by a further 75 basis points, so 0.75% through to the end of the calendar year. As we sit here today, they actually increased the cash rate by a further 50 basis points in early September. This will take the official cash rate by the end of the year, in our view, to around about 2.85%. And should inflation remain north of the 2 to 3% target band set by the RBA, we expect cash rates will continue to move higher in 2023. The RBA, in fact, has increased rates by roughly around about 2.25% since April. So I think it just highlights the extent to which the RBA has been prepared to move aggressively in order to contain inflationary expectations. And while these rate rises haven't necessarily filtered through completely into the domestic economy, we think it'll probably be through to the back end of the year that we'll feel this. As I said, we do expect that rates will continue to move higher. So given this outlook for fixed income markets, it's no surprise that we continue to be underweight the asset class at a headline level, with a clear preference towards flexible rate strategies and direct income strategies across our portfolios. However, despite the negative backdrop for fixed income and obviously coming through higher yields, the spike in the yields has provided some ability for us to selectively add a little bit of duration to our portfolios. With interest rate duration on both domestic and global bonds now at over 8 years, we think there will be some attractive opportunities as we move forward once we move past the peak cycle in cash rates and inflation starts to moderate. With this backdrop, our asset allocation positioning has remained relatively steady over the period. The thematic focus that we continue to consider at a portfolio really remains on two key aspects. One, maintaining an investment allocation that's suited to higher inflationary pressures in conjunction with higher cash rates coming through the system. And we continue to play this exposure through our overweight positions in alternatives as well as property and infrastructure, inclusive of real assets. And secondly, at the same time, maintaining a broad-based investment strategy across the core equity and bond positions. We believe this to be important as it can provide not only further diversification to the portfolios, but equally downside protection in the fact that clearly markets are going to go into a more challenging period over the next 6 to 12 months. To this end, our equity positions remain relatively neutral at a headline level, although we continue to be underweight emerging markets and small caps in favour of broad-based equity exposures. This is for both domestic as well as global equities. So from our perspective, the need to adopt a flexible investment and asset allocation framework continues to be the key focus from an investment point of view. As always, if you have any queries about your portfolios, please feel free to reach out to anyone in the team, and we look forward in catching up again next month. Thanks and bye for now.